Welcome everyone to the Public Podcast. I'm your host, Anne Berry, and here for a tech earnings roundup is Mark Mahaney, Senior Managing Director at Evercore ISI Research Division. Those of you who keep track of Mark will also know that he's the author of Nothing But Net, 10 Timeless Stock Picking Lessons from one of Wall Street's top tech analysts. We are doing book giveaways here at Public, so if you want to get your hands on a copy, just send a DM to the Public Live handle. So, Mark, what a week for tech, a couple of weeks actually. Let's unpack some of these earnings together, starting with Amazon, which is reporting after the bell Thursday. It's one of your top picks. Tell us why.
Well, first, here's what's key for Amazon. Are they able to show recovering margins, improving margins in their core U.S. retail business? Second, how well is the top line holding up for that U.S. retail business? We've had softness in consumer discretionary spend, although maybe there have been some green shoots. So are there? And is Amazon seeing them? And then third, and probably what I should have started off with because it's the most important is, will the company issue the A word? Will they talk about acceleration in their AWS cloud computing business? That's and we don't think that they'll show that in the June quarter. They'll probably provide 1 month a look into the September quarter as they have the last couple of quarters. I don't think that they're going to talk about acceleration in that quarter. But the question is, as the comps get easier, will they? And as AI workloads increase, and as you maybe get some sort of macro stabilization, will you start being able to get that recovery? Because the AWS growth rates in context are lousy. I mean, 10, 11%. This is a company that was running cloud business, growth at 30% plus for years. And so anyway, that'll be the third thing that people look for Amazon. What I like the stock here. I like the stock going into the print because I think there's a reasonable chance they talk about acceleration for AWS for those reasons I mentioned earlier. And if that happens, I think there's a lot of upside. And if they don't, it's just going to be a timing issue. And I think that acceleration will just be pushed out for a quarter. So you'll still be able to make money. But I want to be there before the inflection point.
We will go on to talk about retail, but before we do that, let's just unpack a little bit more some of the points you just raised on AWS, so specifically cloud services. You just said 10, 11%, unbelievable to say it, is a lousy growth rate relative to history. But talk about that 11% relative to Microsoft and what Microsoft had to say about Azure and relative to Alphabet and what Alphabet's seeing in cloud. Talk to us, Mark, about share. Do you think AWS will be gaining share in cloud?
No, I think they've been losing share. And I think they've been losing share they haven't been growing as quickly as Microsoft. And as kind of software investors look at these names, they look at kind of the sequential dollar growth, who's growing their revenue most sequentially in terms of dollars. And only starting in the December quarter of last year, you started seeing Microsoft actually grow faster than AWS. So there's a lot of different reasons here. Some are just better execution by Microsoft. Some of them are kind of endemic with their customer base. AWS skews much more towards startups, SMBs. And Microsoft skews more towards large enterprises and government, which is more stable, where startups will swing down and swing back up. So there's a couple of different reasons for it, but there's clearly been a kind of a divergence. And so what we saw is the setup here into the Amazon print tonight. Microsoft gave us modest deceleration in their growth rates. They didn't see the inflection yet. Google, however, showed no deceleration in the growth rate. I just think the bigger read for AWS is Azure, just because it's so much bigger than Google. And I think what that tells you, and I think Microsoft did talk about what's called optimization, or that's a nice way of saying customers are kind of moderating their budgets or cooling their cloud budgets. That process is still going on, so that's pressure for Microsoft, it's pressure for Google, really, and it's pressure for AWS. And I think that's going to show up when they show this growth rate. I don't know if it's 9, 10, 11%, it's something like that this quarter, but in context, that's versus 16% last quarter and 30% if you go back just a year.
It's extraordinary, isn't it, really, to think about what the benchmark is for the software sector. Let's talk about, again, this topic of market share, Mark, but let's talk about it with respect to retail and talk about what's going on that core, as you said, US retail part of Amazon's portfolio of business interests. Is Amazon keeping its share in e-commerce? Talk to us a little bit about some of the big trends that you're seeing in its landscape.
Well, okay, and so I think it's the opposite here. I think Amazon is gaining share in online retail. And is also you're also seeing kind of the last year. I think it was the title was something like The Revenge of the Store. When
I
you
remember, yeah.
COVID, as you remember, we had this major shift towards online retail, and then out of COVID, it seemed like people were rushing to go back into the stores. Neither of those were, I mean, both of those were kind of exaggerations as to what was happening, but there were those trends. Now you're kind of post, and what you're seeing now is that online retail, based on Department of Commerce data, is once again starting to consistently outpace physical store retail for all the reasons we've known for the last 20 years. Better price, selection, and convenience. But within that, Amazon now, I think we're going to start seeing increasing separation from other online retail. I don't know why, because of the advantages of scale and price, but I particularly am interested in they're really speeding up their delivery. They put out a blog earlier this week, actually, kind of setting us up for earnings tonight, about how they're offering more and more of their customers next day or overnight or same day delivery. And I think that just locks in. This sounds anti-competitive, but it enables and incentivizes people to shop more with Amazon. They're giving you one less reason to get into your car and drive to the store if you know you can buy it from Amazon and get it that morning, that night, or get it the next morning before 7. And that's what's happening. So I think you're going to start seeing more separation of Amazon from total retail and online retail.
And one of the things that Amazon has been very clear about wanting to do strategically, Mark, is more penetration of the consumer wallet, including when that wallet is going to healthcare. Talk to us about Amazon's emphasis recently on telehealth services. It's closed, some healthcare offerings. It's opened up others. As an overall thematic, how do you weight healthcare and healthcare services in Amazon's go-to-market?
It's pretty small. I'm still scratching my head as to whether this is really a good investment initiative by Amazon. When you track them over time, you see that they'll go into new categories where they think that people aren't being served well by the incumbents, where Amazon has some sort of structural advantage. Now, I'm certain that in healthcare and primary care that there's a lot of people who aren't being well served by incumbents. But I don't know what advantage Amazon brings to that market. Like Amazon can go into places like business supplies, industrial supplies, because it's got logistics set up and scale, and their cost of delivery can be lower than just about anybody's. I don't see that in healthcare, so I'm a little stumped by what they've done. It's sort of I sort of ignore it. I mean, look, if something comes out of it, and Amazon's really able to bring innovation in healthcare, great, good for all of us and good for Amazon. I'm just skeptical that they can do it, and I think most investors are too. So maybe that's a positive surprise out there. But as a stock picker, I would not recommend Amazon based on any healthcare thesis.
Let's switch gears a little bit, Mark. Let's talk about Meta. Stock is up 150% year to date. It's been one of the big success stories in tech stock recoveries. What do you think about valuation right now? Cheap, expensive, neutral? What are your thoughts?
Shockingly, for stock that's up 150% year to date, I think valuation is highly reasonable. Let me go further out on a limb. I think it's the cheapest or least expensive, but I'll argue cheapest high quality tech company out there. It's trading, 16 to 17 times GAAP earnings, for an asset that I think is going to be exiting this year with 20% plus revenue growth with expanding margins and share buybacks. You put those three things together and your earnings algorithm is 25-30% growth. You don't normally see companies trading at a discount to their growth rate. There's a lot of reasons why it does. There's skepticism about the Metaverse.
Let's talk about that.
Yeah, and so there are other things like regulatory issues about over Facebook. Is this the next to big tobacco? That kind of thing. We've had these concerns in the past. Can you trust Mark Zuckerberg with your investment dollars? These issues have come up from time to time. So that's why it has what I think is a bit of a discount. But I think fundamentally, I actually think it's cheap, and I think it's a high quality tech stock. So it's actually one of my top 3 picks. It's appreciated a lot year to date, so it's not my top pick, but it's one of my top 3 picks, and I recommend it still.
And Mark, talk to us a little bit on something you just touched on, which is the metaverse or virtual reality. Depending on what you read over the last couple of weeks, there was some unpacking of the numbers that pointed to north of a $30 billion set of cumulative losses by investing into Reality Labs or VR so far. What's your thought on that as an allocation of Meta's capital?
It is a staggeringly large amount.
Yeah.
So maybe that's just stating the obvious. There is some revenue associated with it. I mean, I think actually, if you were to add up the amount of money that Google has invested into autonomous vehicles, into Waymo, I think it's probably about the same.
Interesting.
I actually think that you've got a little bit more revenue actually generated so far with Meta, but it's somehow we all want to live like the Jetsons, and so people are sort of willing to tolerate the Google investment a little bit, and they've also sized it down. We're not doing 15 billion a year in investments; we're doing 5 billion a year.
Right.
Just doing it for longer than Meta.
Mm-hmm.
So I think almost every investor would two things. I think almost every investor would want them to invest in the metaverse. I mean, there may well be a metaverse, and these devices that they're coming out with get better and better every year. We'll see the next Oculus Quest 3 this fall. But I think almost every investor would also like them to invest it a little bit less. Let's ramp up behind artificial intelligence. There's a lot of other initiatives they have, like Threads, that have done phenomenally well, reasonably well.
We'll come back to that, yeah.
And Metaverse is still, you spend a lot of money on something where the ROI is very uncertain. How about we cut that spend in half, and the ROI will still be uncertain. So, but anyway, it doesn't really matter. If you want to own Meta, the stock, you're going to have to pay for a company that's willing to put that kind of money into its metaverse vision. The good news is it's still cheap. And by the way, if we were to take those losses and zero them out, then the stock is like 13 times earnings. It's even cheaper.
Well, let's talk about their core business. So Reels is now used by more than 75% of Meta's advertising partners. The annual revenue run rate for Reels now above $10 billion. Where do you think that 10 billion can get to over the next 2 to 5 years?
Oh, it's going to rise. It's going to rise materially. I don't have a particular number in mind, but 2 to 5 in 3 years. Could it double in 3 years? Yeah, at the growth that it's going at, it should double in 3 years. Maybe not 2, but in 3 years. So right now, Meta's core business is doing extremely well. This is the best fundamental performance probably you're going to find in the advertising space. Maybe not. Trade Desk is also a very good asset, but you have better acceleration with Meta than with any of the other ad names, especially like a Google, a Snap, or a Pinterest. Meta's got the best recovery. There's like 2 basic reasons for that. First is they have the easiest comps. They got most dislocated by those Apple privacy changes
right.
a year and a half ago. The second one is to Meta's immense credit. They're in the middle of these very successful product cycles. They've rebuilt their ad tech stack. They've rolled out Reels. Everybody likes video, but they've also figured out a way to better and better monetize that. And then they've got this click-to-message marketing tool out there. They're monetizing these assets that are really popular globally called WhatsApp and other messaging services. And now they've got Threads, which hasn't been monetized at all, but probably can be very well monetized by Meta. So I give them a lot of credit for this. They've got the best fundamental direction. I think I don't think it's the sector. I don't think we've entered some sort of big macro advertising recovery. I think it's just these product cycles that Meta's done a really good job executing.
Well, they've also had a lot of cost cutting, which has helped their bottom line and the margin side. But Mark, you and I had a previous conversation here on Public Live, really debating whether Threads was going to be the new Clubhouse, meaning was it going to stagnate, or was it going to be the next Reels, a successful product launch? So, some of the recent metrics for Threads is that user engagement has dropped off, that users have disappeared. Some have argued Threads is already dead. Sounds like you are not as pessimistic on what Threads could be as some other commentators might be.
Yeah, I think it's already proven that it's better than Clubhouse. The question is, can it be as big as Twitter? Zuckerberg makes a really
X, company formerly known as Twitter, now known as X, right?
Oh my goodness, you're right. Actually, it could well be that X is smaller than Twitter because the base is declining. So anyway, but the point is made either way. Zuckerberg's point has been, how come you never got a billion user asset out of public real-time news, community chat, a PR site, however you want to define X or Twitter. And if it was, so I think it raises some interesting questions because I think the level of innovation, both on certainly on the advertiser side, but also on the user side at Twitter X, has been pretty wanting for not just under Musk, but over the last 3, 4, 5 years. So if somebody comes in and creates a better, I think absolutely somebody could come in and create a better mousetrap. And I'm intrigued by Meta's ability to do it. And let's just keep, focused on the fact that they can bring so many users over quickly, and then they can constantly iterate on the product and improve it. So yeah, I just think it's the wonderful thing about Threads is it's an easy extension for Meta. You don't have anybody buy $300 space goggles,
right?
And they know how to monetize it. This is easy monetization over time. The question
Early days right now.
The question is, can they create the features, make them compelling enough to drive more and more engagement over time? My guess is that they will be able to, but TBD. But there's very little downside here for Meta investors. I think they spun this up in a couple of months with, I forget now, 30 engineers or something like that. Like, wow, wonderful. They should do more of these.
An option. I'm hearing it's an option.
Yes.
Embedded in Meta right now, Mark. Let's talk about Spotify. Last one for you. Price hikes. We've seen the company raising the price of its paid subscriptions by $1 to $2 across all of its price plans, which on a percentage basis is actually a pretty decent size increase. Thoughts on elasticity of demand? Are those price hikes going to stick with volume sticking with them?
Well, let me back up and just start with the stock. So this is actually, of all the trades we've had around earnings this season, this is probably the one I most disagree with. And I'm very respectful of the market. The market's almost always right, but this is one where I think the market's not right. The stock traded off aggressively on the earnings results. What you're seeing with this company is year to date, gross margins are expanding. Year to date, they're adding more users and more paid subscribers than they did last year. There was just some concerns about whether they were getting lower quality users, but they are clearly gaining share in the online music streaming industry, and they've got pricing power. Do I know that? No, but they have implemented price increases in the past. Nothing like this. This is on their basic plan.
Right.
The rest of them have been on the other plans, but on those other price increases, they haven't had major churn. And then the advantage here is they're going from below industry prices to matching industry prices. Apple's already raised prices.
Interesting.
YouTube has, Amazon, and everybody else has. So you're just catching up with Spotify. So I just think the risk of a backfire on this price increase is pretty small. Like, if you don't like the dollar price increase on Spotify, what are you going to do? You're going to spend the same amount of money at any other site. So I just don't think it's going to be a big churn event. And I think you're going to help lead to this reacceleration in revenue growth. You like to be behind companies that have got pricing power because it accelerates revenue and because it improves margins. And that's where you are with Spotify. I know it's had a big run year to date. I know the valuation is speculative because I can't tell you what the PE is because they're not generating substantial GAAP earnings yet. But
right.
I just, the stock fundamentally, fully acknowledging that the valuation is speculative. And I think the market kind of misread what's happening. So that's why I like it here.
Last question for you, Mark, which really spans across all three of those names. So you've talked about Amazon, you've talked about Meta, you've talked about Spotify. All three of those, in some shape or form, have talked AI over the last couple of months. Real quick, what do you think they're going to hit on when it comes to artificial intelligence being incorporated into their core products?
Well, I think the backdrop on all this is that digital assets have been experimenting with and deploying and employing artificial intelligence and machine learning for several years now. And I think with Gen AI, you're just going to accelerate that deployment. So you could have a real step function increase in both the level of in the quality of the products, in the process which creates the products, i.e., it could become cheaper. You may be able to bring out more products more quickly. And so I'll just to be really specific about it, like AI DJ is kind of an increasingly interesting feature or tool within Spotify that people may be willing to pay more for. Meta is using this to do massively greater A/B testing than they could in the past. Instead of taking 2 ad campaigns or 10 ad campaigns and running them simultaneously and then putting dollars behind the one that's most successful, they can run 100 and put dollars behind. Like the level of testing that's enabled by generative AI is materially better. So I think digitally native companies are going to benefit, largely. They're good executors. They're going to benefit from generative AI. And I think all three of these companies will.
It's all about the numbers. We'll see over time what that translates into. Mark Mahaney, Senior Managing Director at Evercore ISI Research Division. Always a pleasure to have you join. Thank you for sharing your insights. We're going to be standing by, folks, looking for those tech earnings as they come through. See you all next time.